Alright guys, so I started live streaming of this new strategy that I discovered, and it's something that I've been looking for a long time, and for some reason I missed it when I was doing I found a lot of strategies, but I didn't find this one, and this is my new favorite one, for so many different reasons. And so this involves buying calls and selling calls, but you're always net buying over selling, and so you can never like lose more than what you've invested, but you can't even lose that much because of the way that we're playing it. And so I'm excited to show you how this works. And if you have a portfolio margin account, if you have with E-Trade, it's $125,000 minimum to upgrade to a portfolio margin account. But basically, if you have that account, you're allowed to trade based off of how much risk you're taking. And as long as the risk is below your $125,000 account balance, then you can keep on adding to the position. And so I'll get back to that in a little bit after we go over the strategy. But there's about to be a huge bull rally. Like UK just the UK just bought bonds to keep it from crashing, and if they do it, everyone else got to do it. And the midterms are coming up. Like everything, like if you compare the VIX to 2008 to now, like everything says we're about to have a major rally. And so I believe in it, and I'm excited to show you how this trading strategy can maximize your potential in betting on this bull run that's to come. And we're talking about buying months of theta, maybe a month of theta, but like the returns would just be amazing. And so let's check this out real quick. So we closed at 279.94 if you look at the top, which is basically exactly 280. So 279 strike is basically $1 in the money. So we got $1, $2, $3, $4, $5, $6, $7, $8, $9, $10, $11, $12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. Alright, so this guy's $23 in the money. Costs you $2,403 for a contract. Now, I'm showing you the first part of the strategy, which is what makes it so great, and then we add the selling of the options to make it even a little bit better. And you might give up some of the high-end rewards on the up and down, but when you're selling these options, you're basically guaranteeing that over the course of months, you're making 100% on your money. And so let's start with the buying. So this guy is $23 in the money, and it cost me $24.03. So I spend $1.03 of extrinsic value in order to play this option. Now, 280 is 0, so 281 is $1, $2, $3, $4, $5, $6, $7, $8, $9, $10, 11, 12, 13, 14, 15. This guy's $15 in the money, and it's got $1 of extrinsic value, 96 cents of extrinsic value. So we basically have $2 of extrinsic value now by buying both of these. What that means is if the market trades absolutely sideways and just stays at the 280 in the next 9 days, I lose $2 of my total purchases. And sorry, it's not 1596, it's the 1606. So I'm buying both of these, 1606 put and 2403 call. And basically that adds up to a total of $4,000. So of my $4,000, the most that I could lose on this trade is $200. Now I'm going to explain why. So $200 is the extrinsic value. If it trades sideways and expires and everything stays the exact same, you lose $200. Now let's see what happens if it moves down or up. So from 295 to 280, that is a 15-point spread on a roughly $300 stock. That's about a 5% movement. We can say 5.5% movement. Okay, so in the next 9 days, do you think the market can move 5.5% in one direction or the other? Well, here's the thing. If we move $15 from 280 to 295, this guy right here is going to be worth this guy right here, because it's going to be at the money, and that's going to be the extrinsic value. And so on this 15-point move downward, upward on the stock, our put that was betting it was going to go down lost $10 of value. Well, what happened to our calls? If we go from 257 and we go up $15, that would be, down $15. No, it would, well, we're going, so $15 more in the money. That would be 242. Puts us right here. So our 2403 can now sell for $38.27, which is $14 gain, and our 1606 can sell for $5.76, which is less than an $11 loss. So $11 loss, $14 gain, that's $3 positive in a 5% swing in the market. Our $3, our $300 is the profit. So we put in $4,000 to start this trade, and you make $300, which is, what is that, 6, 7, 8%. Worst case scenario, you could have lost $200 if it stays perfectly flat. But we eliminate that $200 loss potential by adding in some selling of options. But this is basically what I want you to realize. So here's the thing though. What happens if it was to move another 5%? So let's say another $15 would be, from 279, that would be 264. Okay, so our 264 is now what we can sell for, and before it was 576. Now our 38.27, if we go 15 more, we'd be at 227, can sell for this. So what happened here? Our puts lost $400, so $4 from the 279 to the 264, and our calls gained $15. So now we made $1,100. That's over 20% ROI. Now, obviously, if it keeps running, like the profits just like that, you can't lose more than that $1.59. And so since you can't lose more than that $1.59, and your calls continue to make money, you're obviously going to make a lot of money. Now, how I originally chose these strikes was I was counting up. So remember when I was going 1, 2, 3, 4, 5, 6, 7, 8, I was using that dollar number in comparison to what the ask price is, and I was waiting until the number I said was only $1 less than So like if I said 16 right here, okay, that's close. That's $1.06 difference. And so if 265 was 16, I could stop there. And so that's how I found the number that I wanted to invest on. Now, what's interesting about this is if we look at let's do the maximum loss of the original position. So we did, I believe we did, it doesn't really matter. So we'll just do the 1794 and we'll do the 288. Or no, we'll do the 1366. I think we're closer to that. Okay. So this 292 loses all of its money when we hit 280. I'm sorry. If the call, so right now it's at 280. If it runs from 280 to 292, then this thing will be worth absolutely nothing. So that is 1366. And if we go from there, how many is that? That's $12. So if we go $12 up, we get to, well, that was actually $11 because the 280 is basically break even. So we need to be at 278 or 268. No, I did that backwards. So we do $11 from here. So our 1794 would have grown to, that's what okay, sorry. 275 or 255. So we can sell for here. And so at the point that we lose all 1366 of the 292 put, we can, our option will be worth $25. Our call option will be worth $25. And so if we look at that, there is $7.50 that is made on that, and we've lost, and there's 1366 that we lost. So that's $7.50. That gives us $6 that we would lose. So the max loss on this trade, and we can run it the other way just to make sure. It's looking like the max loss on this trade, if you just hold to expiration no matter what, would be $600. Now, let's see here. If this guy ran down $11, then that would be $275. It'd be worth $942, $932, and that would be this guy running to 303, which is this guy. So we make $10 on the puts, and we lost $8 on the calls. And so just by looking at that right there, it already tells me that there's a way that I can mitigate the risk between the calls and the puts. So if there's an $800 loss potential on the calls right now, but there is a what is that, that's 800 there, that's 1,000 there, so a $200 profit on the put side, that would tell me that I can mitigate it to where there's a $300 loss on each side. So a maximum $300 loss once I get the math perfected. That's pretty sweet. I mean, let's just say 500 to be safe. So now that we know that our max loss is $500, check this out. I can take that $500 and I can multiply it by or sorry, I can take the $125,000 portfolio margin account that you have with E-Trade or whoever, and I can divide that by the $500. That means I can maximize this play and hit those calls 250 times on each side. 250 calls, 250 puts. And so it's as if I own a massive $1 million portfolio, but we've already mitigated the risk. And so I think there's a massive bull rally coming up right now. And if you got money, like, this is, like, we could call E-Trade together and, like, maybe I'll do that on my live stream, but basically just explain the play that I'm thinking of, and explain that I think the market's going to go way up in the next month and a half, and how he thinks and how he measures the trade. Like, I don't know, you guys got to call somebody or do something, because what I just showed you right there is the most powerful investment tool you'll ever find in your entire life. And it's all about buying in the money options on each side as you start your strangle. And they got to be so deep in the money that the extrinsic value in comparison is less than 10%, and it's an insignificant amount. And so you're basically in a risk-free play. Holy moly. And basically the more theta you buy, just the more in the money you got to start. And so the last thing that I'll go over is that while we do all this, like when we perfect this trade, while we do all this, I can come in here and I can sell this guy for $636, and I could sell this guy for $576. And that's a $13, $14 credit right there. Now, what that means is it can go $14 from 280 in either direction. And at worst case scenario, I will break even. So if I sell these puts right here at the 279 for 576, and it runs to the stock price goes down to 264, and in this case we got to look at the price above, so we're looking at 293. Basically I would lose $700 right there on this option, which actually suggests we can go further than that $14. That's interesting. Because I collect my $1,400 credit, and then I buy for, okay, so that's where I break even. Never mind, sorry. So it's a $1,400 credit, and now I got to buy back for $1,400, and so it's a total wash. And so basically, if it falls between here or if it falls between, oh, so that was right. And so $14 up would be 265. So basically I lose $1,400 there, or I break even $1,400. I collect my $1,400 and I break even on my $1,400. And either side that goes, but anywhere in between, all of this between, so between here 292 all the way to 266, anywhere it closes in between, I make part of the credit, and I get to keep part of that $1,400. Now the way that I'm doing it is, for every put contract I have 2 call contracts on my initial in the money call and in the money put. And that way, if it does move to the point where I have lost like I'm about to break that $1,400 mark and potentially lose money on it, that's where I come in and I add another leg of the of contracts, and that would make me have two contracts of the sells, just like I have two contracts of the in the money options, and that would be on each side as well. And now I'm creating a new perimeter and basically interlocking the perimeters with a $15 swing, to where anywhere that it moves in between that $15 it just ran, I make even more money at expiration, and I should be able to close out a lot of these profits before expiration. Yeah, I just want to show one more thing to show why is this so successful? What am I doing to capitalize on this? And why is it so certain that, like, I found the glitch in the system? It's because of this extrinsic value. Basically, we are preying on the extrinsic value. And what I mean by that is, if I come in here and let's just say I buy for $11.49 and I come down here and I buy for $8.76. When this thing moves down, $5, I only lose $2.60. And that's because the extrinsic value. This has no intrinsic value right here, but because it's at the money and it has 9 days to expire, it's worth $620. And so that's the difference. Like, that $5 swing that makes me lose the $260. If we look at a $5 swing here, I make $350. So because the intrinsic or extrinsic value gets smaller and smaller the more I go in the money, basically when the market moves up, I make all of that movement. Where in this small little window, so from the 11.49 to the 6.96, in that small little window, as this price moves up into more intrinsic value, it loses its extrinsic value. And so we're playing the reverse of that and playing both sides. And basically this window that we're creating on both sides makes it to where either direction it goes, we're taking profits. And so it's all about, like, there's a way to set it up to where it's like, okay, at expiration, if I had to hold this to expiration, I'm going to, like, almost guarantee a profit. Or there's a way to set it up to where if you think the market's going to move, you can maximize the bet. And then there's a way to basically swing trade this as well. If you think it's going to go up 2%, down 2%, up 2%, well, the ones that you're selling, the options that you're selling, if I come in and I sell this guy and I sell this guy, if it goes up 2%, like that's, let's just say $6, this 576 can be bought for 361. And so basically I could cash out $200 right here if I wanted to. And then I could throw on a new leg of the options that sell both sides when it's at the new stock price. And then if it runs back to where it was and goes back down 2%, or goes back up 2%, then the new leg that I just purchased will be in a profit. The other one will be in a loss, but the one that had a loss over here, when the other one made a profit, will now be back to broken even, and you come out net positive, and you can just swing trade that. And so last thing I'll do is we'll just take a look at what a month to expire options look like. You might have to go way in the money in order to actually see what you're looking for. So there's $11 of intrinsic value, or extrinsic value. That's just what it's worth to buy at the money. Now we're $1, 2, 3, 4, 5, 6, 7. Okay, hold on. It skipped from 274 to 272. So because it skipped from 274 to 272, I got to count $2 there. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40. So it looks like somewhere around here we get about $2 of extrinsic value, and we don't really see that change for a while. So at a month, the best it looks like we could do is probably around $2 extrinsic value. Let's try the puts now. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. So like right here, we got $2 of extrinsic value as well. We may have had that a little bit sooner. I wasn't paying that close of attention. So I'd definitely double check. But here I have $4 of intrinsic or extrinsic value that I know if everything trades sideways all the way to expiration, everything trades sideways all the way to expiration, I would lose up to $4 or $400 on this $5,200 bet. Now I can come in here and I can sell for $20, $21. That means it's either got to go to 260 or it's got to go to 300 before I start incurring any possible loss from selling these two options. Well, if we move $21 in either direction, let's just look. 235. So we would be able to sell this guy for there. And 303 and 21 would be 382 or 282. Alrighty. Oops, that should be like that. Alrighty, so on one side I would gain, on that move, on one side I would gain $18, and on the other side I would lose $13.50. So I made $450. And then every time it moves in that direction even further, like that's when my calls start printing way more than what my puts start losing, even though that already started to happen. And in that whole window, if it closes anywhere in between, we just collect our credits, whatever we sold for. It's a beautiful thing, people. You're never going to find a better strategy than this. It's the real deal.